We're going to pick up our analysis of absorption and variable costing. So when we have manufactured more than we've sold, what we have left in our ending inventory or finished goods inventory, as it says here on our slide, actually includes a portion of our fixed costs under the absorption costing method, because we've got all that overhead in that each item, and when some of it's still left in inventory, obviously then we've got fixed costs that are wrapped into inventory. And so increases and decreases in inventory levels can change how our financial statements appear. Now we're going to take a look at this using the Frand Manufacturing Company. We're just going to assume, for the sake of argument, they got no beginning inventory. Their sales are estimated to be 20,000 units at $75 a unit, and that the sales won't change if more than 20,000 units are manufactured. So we're still going to sell the same amount even if we've sold the 20,000. So Frand's management wants to know whether to manufacture the 20,000 units or 25,000 units. Now you're probably already guessing the answer to this, but we'll just play it out. The costs and expenses for those are here. So this is proposal 1, where we're only going to manufacture the 20,000 units, and proposal 2, where we're going to manufacture the 25,000 units, but we're still only going to sell the 20,000 units. What would you do? Well, if you're their management, you are going to look at what the what this is going to produce. And under proposal 1, your operating income actually looks worse than it does under proposal 2. And this is because the way that we have allocated some of those fixed costs under proposal 2 are still sitting in our inventory. And so it shows that we have higher income, because when the costs are sitting in our inventory, they haven't made it to cost of goods sold yet because we haven't sold the items. So this is going to cause our income under an absorption costing method to look higher if in fact we overproduce, if we make more than we should have, than we reasonably thought we could sell. And these next couple slides are basically the long way of saying what I just said, which was basically by stuffing some of our overhead cost into the 5,000 units that are left in our ending inventory, then that doesn't come out of our cost of goods sold, and it looks like we did better than we actually did from an income standpoint. And that's the long way of saying again what I just said. So under the variable costing method, because we're not stuffing any of our fixed costs into our inventory items, then it won't impact our net income, and because there are no fixed costs allocated. So if we don't sell everything we make, then again we are not failing to account for some overhead costs. Now let's look at this scenario, but now we're going to add a third production level. Our sales haven't changed, so scenario 1, we've produced the 20,000, we've sold the 20,000, we got nothing in ending inventory. Scenario 2, we've overproduced by 5,000, giving us some ending inventory. Scenario 3, we've overproduced by 10,000. And we have sold still the same 20,000. So the 700,000 in cost of goods sold is going to be the same across the board. It's just under scenarios 2 and 3, we manufactured some that we didn't sell. So this causes our manufacturing margin to be the same. We then will subtract out the variable selling and administrative expenses, giving us a contribution margin of $700,000 apiece across the board. Then we look at our fixed manufacturing costs, and we're going to take them all. We haven't stuffed anything into inventory, which is still sitting in the inventory figures. So we subtract out our fixed inventory cost and our fixed selling and administrative, and that gets us the same $200,000 in operating income all the way across the board, regardless of whether or not we have overproduced items. Again, I'm going to sort of slowly go through this checkup corner. If you want to, do this, I will let you feel free to do that. So we're going to compare and contrast more absorption and variable costing and look at controlling costs and how we use this information and the role that accountants play in this, because the accountants are going to produce a report which goes to management, and then decisions are going to get made about how we control costs, price products, what we plan to do, maybe attracting a new market segment. Now, when we talk about controlling costs, there are different costs that will get controlled at different levels of management. And, even the frontline person has control over costs. They may not necessarily recognize it, but if you're a frontline worker, unless you're being supervised really, really closely, you have some control over how much waste you have, how quickly you work. You may not be the person who decides what you're going to pay for an item, but how long you let the machine run after you're done using it. Those are all things that ultimately will cost a company money and are within your control. So at every level of management, they're going to be, or even operations, I should say, not just management, there are controllable costs and non-controllable costs. If you are the frontline person, your controllable costs, again, may be how long you leave the lights on, where you set the thermostat, maybe in the warehouse, assuming that's something you have access to. Things like that as a frontline person might be controllable, but there are going to be a whole lot of costs that are above your pay grade that are not controllable. What suppliers you use, what you're going to pay for things, how you're going to purchase in bulk to try and keep costs down. So it's important to recognize that really there's an opportunity to control costs at every level. It's just that some are controllable only higher up the chain. So why do we use these reports? Well, as I said, we've got these sort of controllable costs at a mid-management level, but there are fixed costs that may be well above the level of middle management and maybe more like at the executive level. How much we paid for the factory, what we're going to pay our workers, what the salary scales are going to be. That's not going to be something that's terribly controllable to a mid-level manager, but we still want to be able to have reports that are useful for that manager to be able to evaluate the things that are within their purview in terms of productivity. So when the reports those fixed costs can be filtered out of the reports, and what the manager may be dealing with is only the variable costs that are within their realm, it becomes easier to start looking at how performance is happening at these lower levels and how costs can be controlled. Maybe that's the point at which, the thermostat gets one of those little lock boxes on it. When it comes to pricing our products, that's often a question that companies struggle with. I mean, you can look at, well, what will the market bear? And that's certainly one way to look at pricing a product. But you also want to make sure that you are pricing a product enough to cover the cost of actually making that product. And if you don't do that, then you're probably not going to be in business very long. So if we filter out those fixed costs, we can at least make sure that we are pricing the product at a point that the product is at least covering its own costs. It may not be throwing off anything in terms of contribution margin toward overhead, but at least the product itself is self-sustaining. Obviously, that's, in the long run, we need to have, if all of our products are only self-sustaining and there's no contribution margin, then we can't cover overhead, and that's a problem. But at least in the short run, looking at pricing, we need to make sure that we're at least at a minimum covering our variable costing. We can also use these numbers when we start looking at planning our production. Obviously we cannot plan to produce more than we have the capacity to produce. We've got to make decisions pretty quickly. We're not going to have a lot of time to start calculating in necessarily all of the fixed costs into the analysis. But if we've got those variable costs broken down, sometimes it's a more efficient way to plan what we can produce in a particular point in time. Analyzing market segments too, we can look at this in terms of a market segment approach. Again, these are just sort of short-term analyses, nothing that we would use for financial statement performance type stuff, but this is at least helping give us a sense of how competitive we are in terms of our costing in the regional marketplace. And if we look here, here's an example of our company where we have a northern and a southern territory, and we're able to drill down not only by territory but by individual salesperson to start looking at sales production and how those variable costs are tied into sales by salesperson as well as by territory. We can use the same sales and territory numbers to start looking at a profitability analysis as well. When we look at our northern and southern territory here in terms of the contribution margin ratio, it starts to become clearer which one of our territories is able to give us a bigger sort of bigger contribution toward our company's overhead. And we can see here that the Southern Territory is far better poised than the Northern Territory to give us that contribution ratio, despite the fact that the total sales and manufacturing margins are exactly the same between the two of them. Now, you might be saying to yourself, well, if they're selling the same amount of money, how is the I think it was the Southern Territory. Yes, how is the Southern Territory outperforming the Northern Territory? And I think I thought these were salespeople, but no, these are different products. And the answer is that while they both might be selling the same gross dollar amount in terms of revenue, what they are selling between these products isn't identical. One of these products is a better money maker for this company than the other one, and the Southern Territory is doing a better job of selling those more profitable items than the Northern Territory is doing. And I had mentioned this on the last slide, this contribution margin ratio, which is the calculation up here. We calculate what our contribution margin is over sales, and that gets us a percentage. And now when we look at our sales, we can see that the Guinevere line, we've got 60,000 of it being sold in the north and 30 of it being sold in the south. Whereas the Lancelot, more are being sold in the north than are being sold in the south. So it's based on that product mix that yields the different results that we saw, come on the last slide. Again, they're selling entirely the same amount dollar-wise between the two territories. They're just not selling exactly the same number of each of these different products. So obviously, as a company, we want to make sure that we are selling more of our more profitable items. Just selling more items isn't going to be enough to make sure that we maximize our profits. We want to make sure that the items that we are selling are our best money makers. And here is our contribution by product line, not by territory. Now you can see the Lancelot has a much healthier contribution margin ratio as opposed to the Guinevere. So now you're a manager. Aren't you going to try and push this Lancelot? Because boy, the company's numbers are going to look a whole lot better if you can sell more Lancelots than Guineveres. You could also decide to do some things to kind of manipulate that. You could start charging more for your Guineveres. You could look at what the variable costs of the Guineveres are. Is there something that you can do to, if you've already sold as many Lancelots as you can sell, then perhaps we need to look at the Guineveres to see if there's something else that we can do to increase the profitability of the Guineveres. You can, as I had said earlier, look at this by a salesperson standpoint. And here we see a chart of all of our salespeople in the Northern Territory. And now you can start to look at this based on what each salesperson is selling. And, you know, we've got Beth Williams here, who's selling none of the Lancelot, but double what the other two salespeople are selling. So despite the fact that the overall sales numbers are higher, the contribution margin ratio for both Inez and Deshawn are 10% better than they are for Beth. So if you're the manager, you want to have a talk with Beth and say, hey, you know, your sales are great, but don't you think maybe you could be selling more Lancelots? Because look at what Inez and Deshawn have done, and they're actually a greater percentage of their sales is available to meet overhead than yours, and you're selling way more. So, you know, again, you want to look at that based on salesperson. Now, it doesn't just mean that, what do we got? Beth is working twice as hard as Deshawn. You also want to look at other factors that might influence sales. Is there some reason that Beth's territory, the Lancelot, is not something that's useful? That's got to be taken into consideration. So there are all kinds of factors when you start drilling down to the individual salesperson level outside of the raw numbers that are going to impact performance. Is this person brand new? Do they have an established territory? Are they new to this industry, or are they somebody that's been cultivating leads through and customer relationships through various different jobs in the industry, and are they now able to build on those? So again, lots more that goes into the salesperson analysis than just the product mix and the raw numbers. And I'm gonna let you sort of work through these on your own. Sorry, I keep moving my picture around, but And I'm going to jump over to the last video. I know this one ran long, and we're going to wind up this chapter with service companies.